Here we go. Share the screen. Okay, so we're starting. Wait, 3.3D. Yes, these two. So unpaid balance method, exactly what it means is whatever you don't pay off. So whatever is unpaid at the end of the month. Oh, my puppy is barking in her sleep. That's what the fee is calculated off of. So we're going to use the same rate, 2.5%. Anyone have this number off the top of your heads or on your paper? What was the ending balance? I believe this was like December 26. I know it's like 14 something. Thank you. So at the end of the month, we still owe $1,460.10. Like that's the balance that we're carrying into January. So the unpaid balance method says take the balance that you still have, the unpaid amount, multiply it by the percentage that's being charged each month, and that's your fee. Now, what really happens is we do a daily, what credit card companies really do is they do a daily interest rate, and they multiply the balance by the days, and there's a lot, it gets even more tedious. So this is not quite right, but whatever. So 1460.10 times 0.025, that means we're going to be charged $36.50. So Caitlin, did we answer the question? Yes, we did. Never mind. It says how much interest would you owe? Yeah, that's it. I thought it said calculate the new balance January 1st. And if that's what it said, you'd add to this. So Jennifer, what we did this morning is wrong. This
Okay,
is the only answer we need.
I already submitted it, so I don't know if I can go back and fix it. I mean, you could just minus it from the 1460 and it'd be that answer, but okay.
Yeah, you're fine. I'm not going to take out points. So how are we feeling on that? Is that y'all feeling good on that? This piece for 3.3. Guess I should have told you what page we're on. Page 35. Well, let me wait till I hear your responses. So y'all out there, is everyone good? D, you can just do this 4 times, adding in the new balance, or you could note that this is an exponential model where if we're making no payments and we're not adding anything to the balance, you can just write this, where this A is going to be the sum of these two added together. That's going to be A. And B is going to be 1 plus this growth rate. So 1.025, and you just let X be months and it'll calculate the balance in 4 months. Just smash that in Desmos and you should be good to go. Any questions on that? I'll wait like 2 more seconds to see if there's questions. And then in the absence of questions, I'm going to move on. I love that. Okay. All right. Let's move on then. So today, we're looking at 3.5, and it's got a lot of reading to do. So the main thing we're going to work on is making sure you understand how to read a stock listing. I don't know who Peter Lynch is. He's probably someone famous. Everyone has the brain power to make money in stocks. Not everyone has the stomach. It's risky because you can lose money. It's like rich people's lottery is what I've heard. But if you're careful with it, there's some basic principles where you can make money on the stock market. And everyone can purchase. It used to be, in order to purchase stock, you had to go find a broker, and there were fees, and there was all kinds of like hoops you had to jump through. Nowadays, you can just download an app like Robinhood and give them your social security number, link up a bank, and you can buy stock to your heart's content. So what are your impressions of the stock market at the moment? Yeah, right. There's anger. There's, like, you've heard of Wall Street and Main Street. So there's people that make money off of investing, and there's people that make money off of working, right? Is maybe the thing people make differences between. I don't know. It's a legitimate way to make money. So let's highlight what is a stock. So what you're literally doing is you're purchasing the company. You're becoming a part owner of the company. And this is like when you become a corporation and you go public. So I don't know if y'all remember when Facebook went public, a share was worth a particular amount of money, and it like shot way up. Nowadays, Facebook is losing, its value has dropped a ton. The other thing is, if you've been watching Twitter with the purchase from Elon Musk, Twitter has been losing value. Its stocks have dropped in value. And there's lots of different types of reasons why that can happen. Sometimes it can just be the tweet from a president. Sometimes it can be the Reddit army making claims like on with GameStop. And other times it can be wars in Ukraine or hurricanes, or it can be that the company is actually making money. So people start to value it. Okay, so that's all stock is. You're purchasing the company, you're a part owner, and so if you own a portion of the company, you're also entitled to its profit. And there's two ways you can make money with the stocks as a shareholder. That's what you're called. One way is you buy the stock for a price and you sell it later, hopefully for a higher value, like it goes up in value over time. And it's not guaranteed at all. Another way is through a dividend. What the dividend is a share of the profit that the company made. That's often paid quarterly. Not all companies pay dividends on their stock. Some of them reinvest the profit back into the company. So those are two very basic ways. Then there's stops and puts, and there's bets on the company losing money or going up, and there's all kinds of other complicated ways to make money off of the stock market that we do not cover in this class, and I don't personally understand them. I haven't studied them, like derivatives and all kinds of things. And I should make a disclaimer: what we're about to learn is just the basics of what stocks are, and you should not think that this is investment advice and that you should go out and purchase stock. Although I think it's fun if you have some money to play with. Okay, there's another type of thing that's a bond. So bonds are, the government sells bonds. It's different than stock in that you don't own the company. There's just agreed upon amount of income you make off of the bond. So they tend to be a safer bet, but you get less money. So you get the original amount of money you put into the company plus an amount of interest that is advertised. They tend to be safer. but they don't make as much money. So how are stocks bought and sold? There's a bunch of different stock exchanges. There's the New York, there's one in Hong Kong. I forget all the ones in America. There's bunches of different stock exchanges all over the world. And it used to be that there was an actual person that you had to purchase things through. That was called the stockbroker. Nowadays, there's what's called online brokers, which is just an app. And a lot of times there's a commission. You're charged an amount of money to buy and sell stock by the broker. There are certain companies that don't charge commissions, but there are still ways they make money, like Robinhood is an example of one. Okay, so this is a stock table, and it has a bunch of different information. So first off, here is the exchange where this particular stock is bought and sold. It's the New York Stock Exchange in America. This is the name of the company, Acme United Corporation, I think, right? And this is the stock ticker. So it's the 3-symbol thing that's used that you'll see like in newspapers and whatever. Okay, so then we have all of this information. So previous close is the value of the stock. So it's this big number at the end of the trading day, previous day. So since today is Monday, if this was a stock ticker, well, it says March 1st at 3:45 p.m. But if this was Monday morning, we'll go get a live one in a second, then this would have been the closing value of the stock on Friday at 4 p.m., which I believe is when the stock markets close. Although we'd have to look at the different exchanges close at different times. So then the open is the starting value when the market opened. Now, why did it drop? There could be all kinds of reasons, but there are trades that can happen outside of market hours. So there's people buying and selling when the market isn't active, and all of those trades go through when the market opens. And so for whatever reason, the value of the stock dropped a little bit from the previous close to the next day, based on probably more people were selling than buying or something like that. A bid is what someone is willing to pay for this amount of shares. So someone has put out an order. They want to buy 200 shares of this company for $17.32. And this ask is what someone is willing to sell the company for. Someone is willing to sell 100 of their shares for $17.48. The 1-year target estimate. Someone has done research or whatever, and they believe that the shares of this company in a year from March 1st, will be worth $23.25. So that means there's an increase. So if you bought at $17.40, in a year, you would have made roughly $5 per share. So if you bought 1,000 shares, you'd have $5,000 you'd make. Now, this beta is an interesting thing. Our author says that beta, where is it? Beta refers to the volatility of the stock. And that's a measure of how much the price fluctuates, meaning goes up and down, up and down, and up and down. So you don't want stocks to fluctuate all over the place from a day-to-day basis. That can be scary. So this is kind of how to read that beta. If it's close to 1, then it follows the market as a whole, which tends to be fairly stable. Like you don't see huge drops in the market, except for what was the Great Depression. There was like a 20% drop in the market as a whole, which just like erased billions of dollars for people. And then recently, when Bear Stearns crashed, there was a big drop in the market, and so people just lose tons of money. So typically the market as a whole is pretty stable. So numbers close to 1 means it's following the trends of the market. So if it's lower than 1, it means it's more stable. And then if it's larger than 1, it's less stable. If it's negative, it's inverse to the market. So if the market's going up, this particular stock is going down. If the market's going down, then the stock is going up. GameStop is an example of that, back when it was doing its crazy thing. The earnings date, July 24, 2019, it's the next time the company is going to release data on how it's doing financially. So the accountants have to prepare a report that says, here's all the expenses, here's all the money that came in, here's our profit. All right, so then we have the days range. So this is the lowest value of this trading day, March 1st, that the stock was at. Notice it was the opening. And this is the highest it's been for the day. Notice it happens to be the current value of the stock. That's not always true. And this number will change throughout the day because this number changes moment by moment. And then the 52-week range, it's the same thing as the days range, except that it's for a year-long period. So you can see that the high within the previous year was matching the 1-year target estimate. So at one point, a year from March 1st, a year back, the highest this stock was valued was $23.56, and the lowest was $13.50. Okay, then we got the volume. Volume is the number of shares being traded that day. So on March 1st, there were 620 shares being traded. That's very low volume. And then the 3-month average value, there's 9,675 shares being bought and sold. Okay, market cap. What's up with that? Our author tells us here the market cap is the total value of the company. So it's calculated by multiplying the number of shares that are outstanding that people have bought by the current price. Now, if you notice, this nowhere in our ticker does it say how many shares there are. So we can calculate the number of shares by taking the volume or the market cap. So this particular company is worth $58 million. $58.6222 million. And we can divide it by the current value of the stock, which is the 1740, and that will give us the rough amount of shares that are outstanding. So I'm getting 3.3691 million shares, roughly. The PE ratio is we'll talk about it a little bit later in the textbook. I often skip it. Where is it? It's down here. It's the current market price divided by the annual earnings per share. And it used to be a measurement of how, if the stock is priced reasonably or not. So is it worth buying or not? It was one way to help you determine ways to purchase stock. Earnings per share is the amount of money you receive per share. So it's not what you receive, it's what the company has made for each share of stock that's been issued. So if you think what happens, the company issues the stock, people buy it, and so the company gets the money for that stock, and they use that to make themselves more profitable, to buy more product, to build factories, to do whatever. So this company was making $1.30 off of each share that they sold. So if you take the 3.369 million 91 million shares and multiplied it by this, you'd get how much profit they made for those shares. And then this last one is the dividends. So if you had one share, each quarter you'd get 48 cents, which is 2.8% of 1740. So let's just double check that. Oops. Okay. Yeah, if I multiplied this by 100, that's roughly 2.8%. So what this is saying is this particular stock pays a dividend of 48 cents per share, which is 2.8% of the current value of the stock. All right, that's all the stuff. So what I'm going to do is I'm going to go to one of my favorite places to look at stock markets. Go to Yahoo Finance. And this is one place to look up stock. And for fun, let's look up Facebook. I was reading an article yesterday that Facebook is losing tons of money for whatever reason. So I'm just going to Google Facebook. Meta is one of its companies. Oh, tokenized stock. What is that? I think Facebook stock ticker is just FB. Yeah, there we go. I forgot Facebook got renamed Meta. So its stock ticker is Meta. Okay, so here is our stock ticker with all the same information as before. Previous close 90.79. It opened at 94.78. Notice a bid. Someone is willing to pay 95.35 for 900 shares. Oh, it's changing. Oh, it went up again. Wonderful. 52-week range. Look at the volume. 57 million shares have been traded today. I really like this these graphs because we can see what's happened. Like this year, notice it's been dropping quite a bit. We can look at all time. So Facebook peaked here back in August of 2021 at 379.38 per share, and then it's dropped down to 90.79. Well, now 95.41. That's a huge decrease in value, right? Like that's crazy. If you bought a ton of stock at the peak, you lost a ton of money. Okay, so I think what I want to do, since we've just gone over some of the reading of a stock ticker, is just have you open up the worksheet. And I've got a stock ticker from way back in time listed on here. This is GameStop's stock ticker. And I want to see if you can answer A through C. All right, so let me just give you 5 minutes. It's probably way too much time. There's enough time for me to go get some water. 5 minutes and see if you can't answer A, B, and C. Set a timer for 5 minutes. You all can let me know once you are done, if it's sooner than 5 minutes. Okay. What's the high and low of the stock in the last 52 weeks? Look at that insanity. In a 1 year period, this stock went from $3.77 to $483. Did you all remember GameStop? What's wrong with this? Remember that? It was called the meme stock because a bunch of the Reddit people got on there, and it turns out one of the guys behind the stuff on Reddit was actually a professional stockbroker. Nice. So if you had bought at 377 and sold at 483, if you'd purchased enough, you would be able to retire. And there are plenty of stories of people that did that. They got lucky. They bought at a particular level and sold when it reached its height. On this particular day, which it doesn't say the date, it just says 11:32. I wish I would have gotten the date. It was down to 238. So it lost half its value, roughly over half its value from the high. Okay, so how do we measure volatility? So volatility is the amount of change, the fluctuation in the stock. So from day to day, is the stock going up and then down and down and then up and all over the place, or is it kind of a stable, roughly the same price over time? Yeah, that's beta. So beta is a measurement of that, and here beta is negative 1.94. So what we said, oh, that's supposed to be beta, from the textbook is that beta, wrong one. Beta, beta refers to volatility, which is a measure of how much the price fluctuates. If beta is close to 1, then the stock stability is similar to the rest of the market. So, and then I said, if it's negative, it's opposite the market. So this is volatile and opposite the market because it's far away from 1. It's above 1, and it's not super far. Let's see. Let's look at what Facebook's beta is right now. Where is it? Beta 1.14. What's another one? Twitter. I bet Twitter's kind of all over the place. Twitter's beta. Oh, it's a stable point, 0.53. Is that the right one? As of October, this isn't the right one. It's not being traded anymore. Is it not a publicly traded thing?
I'm pretty sure it got changed where it's not publicly traded anymore.
Is that what Musk did? He took it out.
Yeah, I'm almost sure I've seen a news article about it. Didn't care to read much of it, but I remember seeing something about it.
That makes sense. Looks like he took it off the market October 27th. Cool. Okay. How about Amazon? Amazon is one that's a pretty stable one. Tends to be, well, 1.23, not so stable. So this number, I've seen like 3s and 4s, which means it's highly volatile. So it can be a bunch of different things. So in this case, we're going to say it is more volatile and opposite the market. So if the market is going up, then this stock is going down. And if the market is going down, this stock was going up. And so in this case, I think the market as a whole was kind of dropping. This was like in the midst of COVID. I think when this went on? I don't know. It just it shot up like crazy high. Here, let me show you the graph. GME, right? GameStop. Here it is, GameStop. Let's see what its value is currently. Oh my, it's down to $25. What? So if you look at all time, see it went here, $1.67, $1.96, January 2020, and then it just went insane. 81. Boy, where did I get the $233 stuff? Must be somewhere in here. Let's look at the 5-year. Oops. They don't even show that 233. Man, what happened to it? It was there, I swear. 2-year, 5-year. Look at that change. 1,878%. That's the amount of profit you made. Okay, I gotta relax. Okay, how many shares are currently outstanding? How'd y'all get that? Did you all not get that?
I did not get that. I guessed, but I was out of the room when you went over what that would be. So
Oh, no worries. Let me do it again. So where this comes from is the market cap is the value of the company, meaning it's the value. That's it, Mike. It's more volatile because it's a number larger than 1 or less than -1, and it's negative makes it the opposite. Yep. So it's going the opposite direction of the market. Good. Okay, so the market cap is the value of the company, which is simply the number of shares times the current price. So for ours, if we want to know the number of shares, it's just the market cap divided by the current price. So the market cap, it was worth $16.849 billion. Woo, insanity. Divided by $238 per share. This will be the number of volumes or number of shares outstanding. So I should label that shares. And that's approximately equal to 16.849 divided by 238.0709 billion shares. Does that make sense, y'all? There's other things we could read. Notice it doesn't pay dividends, dividend and yield. Notice the earnings per share. It was not a profitable company. They were losing $3.31 per share as a company. So it didn't make sense that people were buying this. Conventional wisdom was like, you shouldn't purchase this. But that's one of the things with the stock market is there's psychology in it. If everyone's buying, the price is going to go up. If everyone's selling, the price is going to go down. Okay, so let's go back to the notes. We're now going to work on how to do questions D and E. How do you calculate profit off of buying and selling? So here we go. Here's a little setup. 2 ways to make money off of the stock. 2 main ways. You buy shares that pay dividends, or you buy stock at a low price and sell it at a higher price. And then that's how you do it. So the amount that an investor receives from the sale of a stock is called the proceeds. The proceeds are equal to the amount of the sale minus the broker's commission. So all of this is going to be very simple calculations. It's going to be percentages and multiplication. That's it. But keeping it organized of what do we add together, what do we subtract, how do we get it all is a little tricky. So organizing it is important. So Apple, just for fun, let's see what Apple is today. On April 1st, 2004, it was $12.89. Apple, of course, there was a point where it was going to fall apart. And currently it's at 136.96. Ooh, huge increase. So let's say that an investor bought 600 shares at that price, $12.89, and they used a broker that charged a 2% commission, meaning it cost you 2% of the total sales. So if we want the amount of commission paid, we're going to take $12.89 And we could take 2% of that and multiply it times 600, or we could do 600 and then times 0.02. Like if we just multiply these all together, that's the total amount of money we pay the broker to initiate the purchase of the stock. So we would have owed our broker $154.68. Now, if we want to know the cost of buying the stock, we could separate the two. We could say, well, what's the cost of all the shares? So we need the cash for this. By the way, one of the things with investing is you can't use credit to invest. You have to actually have money in your bank account. It has to be actual cash. I think that's an important thing because you could lose money. So if you use credit, you're losing money because of the credit card fees, and then losing money on the stock, it'd be a double loss and you could owe more than you spent. All right, so this is the cost of the stocks. And our fee was $154.68. Add those two together and we've got our amount. Hey, I can actually do this one in my head. Hooray. $7,888.68. We need this much cash in our bank account in order to initiate this purchase. How are we doing? I'm out of coffee. That's how we're doing. We'll label this total cost of investment. Awesome, Alyssa. Okay. So now there's things that can happen. One of the things is there's a stock split. And I used to own some stock. I don't anymore. But I did have, actually, I think I do have some stock. I should check my broker. Robinhood is what I used. I did, and this did happen. You can do splits. Most common is a 2-for-1 split. That means if you have one share, the company gives you 2 shares. And what happens when this split occurs is that the value of the stock gets cut in half, but then you have double the shares. So there's no change in the amount of money you have invested, except that if the value of the shares go up, you now have 2 shares as opposed to 1 share. So it's a really good thing for you if the value of the shares go up. So it turns out back in February 8, 2005, they did a 2-for-1 split. And then in June 9, 2014, they did a 7-for-1 split. If we multiply together what's happened here, it ends up with a 14-to-1 split. Meaning our investor, if they didn't sell anything anywhere, then they would have had 14 shares for each 1 share that they bought. So they purchased 600 shares. So by the end of this time frame, they would have 14 times 600, 8,400 shares. Woo, nice. Right? They 14-oopled their shares, if that's a word. I don't know what the word is. So if the stock had stayed the same value as when they purchased it, or returned to the value when they purchased it, their investment would be worth $108,000. Right? They put in 7,000 and it would have gone up to 108,000 if it remained or returned to this price after the 2-for-1 split and the 14-for-1 split. Well, of course, if you look at what happened here, this went way high. So here we come to the profit part. So the clever friend, the Apple investor, could have sold her shares for $174.97 March 1st, 2019. If she had done so using a brokerage with 1.5 commission, what would her profit have been? All right. So we need a little formula to keep track of what happens here. Profit is equal to the proceeds from selling the shares minus the cost of purchasing the shares. We know the cost already. We had it right here, 788.68. So how about I just write that somewhere over here, 788.68. So this was the total cost to purchase it. It includes the commission and the price for the shares. So let's calculate the proceeds. How much are we going to get? Well, she's got 8,400 shares that she's selling, and she's selling these shares for $174.97. Now, there's a commission here. So think carefully. This calculation, this 8,000 times the 174, 8,400 times 174.97, this is cash that's going to go into our investor's bank account. The commission is the money we have to pay the person that's executing the sale for us. So what percent of the proceeds are going to go into the bank account of the investor? So think of it of this. We take 100% of the proceeds and we subtract, nice, love it, Jennifer, the 1.5% that we have to pay our broker, and we end up with 98.5% of the proceeds is ours, or the investors. So if I multiply this by 0.985, we get the exact amount of money that goes into our bank account. We get the proceeds. All right. That's a straightforward calculation. 8,400 times 174.97. Whoa, $1,469,748. We don't get to keep all of that. We have to give 1.5% to our broker. So 1447,701. 1447,701.78. All right, that's the proceeds. Now, here's the thing to think about. Did I do? Yes, I did this right. How much profit did she actually make? Well, what you would do is you would subtract the initial amount of money you had to pony up in order to purchase these stock and make it possible to make this money. So we're going to subtract the 7,888.68, which, right, is basically nothing compared to the amount we ended up with. I mean, this is a huge amount of profit. So our investor made $1,439,813.10. Amazing. I would love for that to happen. My problem is I don't have $7,000 in my bank account in order to purchase stock. And then the other problem is how could we predict that Apple's stock would do this? If you look back at when this originally was purchased, it was back in 2004. Who knew that Apple was going to become the amazing company it is today? And then the other thing to think about is from 2004 to 2019, that's 15 years of investing that have happened. So what we could then do is say, what was the profit per year? All right, she's making $95,000 per year. Well, that's more than my salary. That's wonderful. I'd love to make that happen. Now, one of the things that investors look at is not the amount of cash you bring in. Think about these big companies that are making millions and billions and trillions. Well, very few companies are making trillions of dollars, but their profits are in the high millions and billions. What we're most interested in is the percent profit per year, which I'm going off the cuff here. So what we want to do is figure out what percent of the original investment did we get as a return. So I'm going to call that percent return. And that's equal to the profit divided by the cost And then really we want to know what percent did we earn per year. So that would look like this, which would be the profit divided by the cost divided by the year. So usually it's nice to calculate each of these one at a time. So let's get the percent return. This might blow your minds. So we're going to take the profit, $1,439,813.10. And we're going to divide that by the $7,888.68. And this is the percent profit. Oops. Ooh, so this is the decimal version of the percent, 182.516 as a percent. So we need to multiply that by 100 and 2%. So over the lifetime of this investment, we earned 18,252% return on our profit. Amazing. Now, that's not a really good measurement. That hides the fact that this happened over a 15-year time period. So what we really want to do is divide out this percent and get our annual return rate. That's what matters the most. So we'll divide this by 15. Whoops. And you still get 17% per year. That's an incredible rate of return. Conventional wisdom and data says that the market has a 6 to 7% return rate. That's a pretty good return rate over time. Awesome. I wish I would have done this investment. I certainly didn't. Okay, so you have seen how to calculate profit for stock when you buy low and sell high and keep track of commissions. So I'd like to give you some time to answer question D. So here I'm telling you that on January 4th, 2021, GameStop was at $17.69 per share. And if you'd purchased 1,234 shares of GameStop on that day, and you had to pay a 3.1% commission, what would be the cost of your purchase? So that's the first part we did. And then you're going to sell your stock here for the current bid price. Notice the bid price is right here. All right. So you're going to sell it for that. What would be your profit? All right. I'll give you 5 minutes and then I'll check in. I suspect you might need a little more time because it's a lot of like moving pieces that you have to keep track of. What's going on with the commissions at the buying and selling times. So see how far you can get. Set a timer for 5 minutes. All right, that was 5 minutes. How we doing? Great question. It's per share. One way you can tell is by the price. Because if this is the current price, 238 per share, which is what this is, there's no way someone's going to sell you 1,200 shares total for 238. I mean, that's an insane deal, right? So that's one way to keep track of that. Cool. I will let you all keep working then. I'll do maybe another 5 minutes to finish up E. Don't be afraid to ask questions though. Set a timer for 5 minutes. How's everyone else doing? You all done with D then? And E? Okay. I'm going to start this. Our goal here is cost. Okay, nice. So I'm going to show you a different way to calculate it. Maybe you thought of it. Since we're adding the commission to the price of the shares, because all of it is money leaving our pocket, we can write this as 100%. So all of this plus the 3.1%. So we can write this as 1.031. This will directly calculate the cost. And then you don't have to do the percent and adding and all that. It's a little shortcut to what I did. So that's 22,506.17. Is that what you all had? The final amount? You may have done it differently. That's the total cost of the shares. Nice. Okay, awesome. So if you did 0.03 for one of them and then added it, that's fine too. Okay, profit, remember, is proceeds minus cost. So maybe it's easier to calculate the proceeds first, and maybe that's what you did. It doesn't say what commission, does it? Oh, hey, oh, I hate that sound. So we can do this two ways. We can assume we could assume a 3.1% commission, or we could do zero commission. We could do it either way. So if we assume a commission, we're going to take the 238.12. Well, I should ask, what'd you all do? Did you put a commission on there, or did you put no commission?
I put no commission.
Okay. Let's go no commission then. Perfect. Anyone else do no commission? Okay, so 2 out of 4. Perfect. 50%. So we'll do no commission. So we're going to take the 238 times the 234, and that's just the profit. That's it. That's done. Well, I'm sorry, the proceeds. So 293,840.08. Not bad, not bad. So profit is just the difference between the proceeds and the cost. By the way, this could be negative. You could have negative profit. You definitely don't want that. But in your project for task 4, there's a good chance you're going to have negative profit. Don't be alarmed. Just know that could happen. So you would have made $271,333.91. We don't really have a time frame because I didn't give you a date for this, but I think this is in under a year's time. So we could then calculate the percent profit. And that's a similar one to the Apple. This is 1,200%, 12.0 or 1,206% profit. And I think this is within a year. I really do. But it's interesting that that doesn't show up on GameStop, that the price was at this value anywhere. Okay. Boy, that's it for 3.5. And if we go in and look at, I often don't mess with this. Because I don't know that it, I don't really know what it is. And then I also often skip the bonds and just do those two. So what questions do you all have about this stuff? Don't look at that, that's stats. I mean, we did the whole worksheet, didn't we? Shame on me. Let's take this moment to glance at the project while we're at it. There aren't really any formulas on this. I'm sure you've noticed. for this section. It's more keeping track of what's going on. Oh, let me remind you that I reopened the midterm for those of you who wanted to take it. If you didn't get a chance to take it, then you now have a second attempt to take it. For those of you who already took it, you have a second chance to retake it. I didn't let you see the problems and what you did wrong because I didn't really change the midterm. So that's why you can't see what you got right and wrong. You can see it after the second attempt. Let me know if you're struggling with the technology so I can help you. And I've been really bad with emails, and like if you've emailed me through Canvas, it's really kind of tricky to find. I mean, there's like this, it's such a terrible way to find things, and these numbers are here to show how many. So I've just been really bad with that. So if you sent me an email in Canvas and I haven't responded, please send it again. I won't be upset. You should probably be upset that I never responded to you, so I'm sorry for that. But if you don't mind doing that, that would help me get back to you. Okay, let's do the lesson check for 3.5. Thank you, Melissa. That's a good idea. What is it? I think it's what's the price? The stock. What is the current price of the stock? So that's on page, we kind of skipped that because we went straight to the homework instead of doing it here. It's this one, and it's the 162.28. So the current price is here, previous close here, open here, and then bid and ask. Let's make sure that actually goes in correctly. Who knows, maybe it changed or I did something wrong. Yay, I got it right. Unfortunately, if you typed it in wrong, it does not allow multiple attempts, of course. Now it does. So I did that super fast. Here's 3.5 lesson check. Answer 168.28. If you're noticing, we're going to be finishing unit 3 on Wednesday, which means the project is coming due sooner or later for unit 3. And then we'll be starting unit 4, which is the last unit of the semester, and then we'll be done. Can you believe that? And then we have Christmas break. We have Thanksgiving break in 2 weeks. Okay. What do you all need from me? Anything? How can I help you be successful in this class? No, it's not 3.1. Awesome. Enjoy that. That's a super exciting project. If you all are happy with where you're at and you have no questions for me, by all means, take off. This was a shorter section. The next section is also fairly short too. So there will be extra time in class for you to work on things and ask questions if need be.
Can I just double check D and E? D, we got 22,506.17.
Nice. Good.
And E was 200,000 or 271,333.91.
Nailed it. That's it.
Okay.
You got it. Nice.
And would you mind briefly going over scientific notation
Yeah.
for me?
So let's see. So if, let's say we have a very large number that we want to write in scientific notation. So I don't know, 33,465,310. So if we want to write that in scientific notation, what we do is we note where the decimal place is. It's right here. So if there isn't one, it's all the way to the right. Am I sharing my screen?
Nope.
I am not. Okay, here we go. There's our number. So if it isn't there, then you would put it all the way to the right. And then what you do is you count how many decimal places do we need to move this till we get a number that's between 1 and 10. So the number that's between 1 and 10 is the 3. And then all of these other numbers are important numbers, so we got to keep them all. And then we do times 10 raised to however many times we move this. So 1, 2, 3, 4, 5, 6, 7. So this would be that number to the 7th power because we made it so much smaller by moving the decimal to the left. We turned it to 3.3 versus 33 million. Does that make sense?
Yes. So the number that it's raised to, or the exponent, that is the amount of times that the decimal place has moved.
That's it. So like another example, let's say we had 36,546.82. So here, we already have a decimal place given. We're going to move it to the left 1, 2, 3, 4 times. So our number is 3.6546. This 8 and 2 don't have any effect on that exponent. It's just 10 to the 4th.
Okay, so if I was going the reverse of that, then I would just move the decimal place back over 4 times, and then I would have the original number.
That's it. Yep.
Because I'm pretty sure I missed a couple questions on the midterm, like where I was like, I struggle with that for some reason. So cool.
One other thing that could happen is if you have more places that you move than numbers, you have to include zeros. Like here's at 1.23478 times 10 to the 8. So I got 1, 2, 3, 4, 5, 6, 7, 8.
Yeah, okay. I got that. Cool.
And then the flip is if it's negative, you're moving it to the right.
All right. Cool. All right, that helps for sure.
Excellent. Great work. Oh, yeah. If you have any other questions, Mike, ask away. I'm here. I'm all yours.
I don't have any right now, but I'll see you Wednesday and have a great day.
Sounds good. See ya.
See ya.